Hello and welcome back. I'm Natalie MacDonald and you're joining me for today's Sydney Direct. Today I caught up with Ben Le Brun at OptionsXpress for a little ASX wrap up from what was a pretty hefty week. Ben Le Brun, thank you so much for taking the time to chat to Dukascopy TV. Always a pleasure to catch up with you.
Pleasure to catch up with you, Natalie.
Okay, so we're doing an ASX Week In review, and it's been a pretty hefty week to say the least. What's been the key driver though? Is it that Greek debt crisis or is it that China equity volatility?
I don't think we could talk about the week without mentioning them both. Now, which one's been adding to the volatility more than the other? I mean, that is open to discussion and interpretation, I guess. Of course, at the start of the week, we got the Greek referendum, which came in as a surprising no vote. That got us off on the wrong foot, no two ways about that. But as the weeks progressed, the news flow has seemed to improve coming out of Greece, and attention has swung back to China and the Shanghai Composite, and all the equity markets over there getting absolutely pulverised at the moment. So that has really added to the complexion of negativity. Now, it can be somewhat ironic, given the fact that it's had this meteoric rise of over 100% in the last 12 months. No one's talked about it. No one's sort of added into more optimistic or rosy forecasts for global growth. As soon as the 30% cream's been wiped off the top, everyone's, the doomsdayers are out. So, look, neither scenario is particularly positive, and it's the uncertainty that's probably killing equity markets more than anything. So that's why we've had such a wild ride this week.
Is the measures that the Chinese government have put in place to support that, have they actually prompted that sell-off further? I mean, nothing spreads fear like a few panic measures. And how does that kind of correlate then with some of the market behaviour that we're seeing domestically?
Well, again, that's open for interpretation and debate. The Chinese authorities are doing what they can. They've seen that there is a degree of, well, let's just call it overall profit taking, and let's face it, there's been some serious profits on offer, and it's almost been like a snowball effect that some of these companies are getting absolutely slammed. So the IPOs have been put on hold, stocks have been suspended from trading, you're not allowed to short sell. All these things should feed through into a bit more confidence in the share market, but as you mentioned, it really hasn't played out that way, and if anything, it's sort of added to the more negative tone over there. Now, of course, it's a centrally run government over there, and the authorities can pick and choose the headlines that they like. So, in the last 24 hours, unsurprisingly, some of the financial press headlines have been very, very glowing of Chinese state-owned companies about to take significant stakes in equities and ETFs and all these kind of things. So they've literally thrown the kitchen sink at the problem, which is probably why the Shanghai Composite was up 5.8% yesterday. Whether this is sustainable or not, I guess, is, again, open for debate. What happens when a lot of these stocks, about a third of companies that have been suspended from trade, what happens when they come back on for trading? It very much remains to be seen. I don't know that too many people have got a lot of faith or confidence in terms of what's happening in China. It's a very immature market in terms of investing over there. So, we could be facing a scenario where shares are significantly lower from where they stand at the moment, and obviously, with the sort of dire forecast being made from financial advisors and analysts, that's not going to feed through into anything particularly positive on a global context.
So let's bring this back locally then. Big banks struggling, not really much surprise there. One of the sectors though that's kind of come through as this sort of shining light almost is the industrial sector. Now, is the fact that companies like UGL, for example, starting on such a low base, actually supporting them more through this period?
I would suggest so. I mean, UGL, one that you mentioned there, and as an example, has been a prime takeover target for a while. So, and it's been a stock that's been badly beaten down. That mining services sector has just been, it's been non-stop in terms of the selling for the last couple of years. So, there is always pockets of resistance. Your defensive style companies would be the ones that I would sort of aim for. Healthcare stocks, which seem to be, coming out of the GFC, regardless of what sort of shape the economy is in a global context, they've just been winners. I mean, it doesn't matter what happens in China, if you're always going to look after your health as a top priority, aren't you? So that's why your likes of CSL, your Cochlears, your ResMeds, your Ramsay Healthcare, they've been amongst the shining lights for our market for the longest time, and probably will continue to do so. But those industrials, I mean, they're holding up relatively well. It's probably the takeover targets that are doing more better than others. When it comes to the banks, I mean, it'll be interesting just to see how they go into the next earnings season, given that they traditionally, I mean, the earnings numbers, are really, really strong, and the dividends, you can almost set your watch to those dividends. So, the closer we get to earnings, the more likely they are to have a little bit of a rally.
Now, in April, something investors were attempting to set their watch to was the ASX hitting that 6,000 level. Mid-June, Citi turned around and said that they still saw that 6,000 mark in sight for year end. With all that's gone on, even just this week, however, though, is that taken off the table, really?
Well, the seasonal factors suggest that this is a very slow time of year. It's where we see a traditional pullback in the share market, only for us to stage a rearguard action late in the year, the so-called Santa Claus rally, and that can add 2, 3, 5% to the equity index by the end of the year. So we need a 10% rally between now and then to get us over 6,000, which might be a bridge too far. And of course, there's no surer, there's nothing surer in terms of price action that you can predict is our earnings numbers. I mean, that's just completely reflected in terms of a share price. Now, there's not too many upgrades going on. There's more downgrades than upgrades for Australian stocks. So with that in mind, I was in the 6,000 camp by the end of the year. Might have to revise that down slightly, more like probably 5,800. But I'd say 6,000, 2016 early stages, I would suggest, yes.
Ben, always great to receive your comments. Thank you so much.
Thanks, Natalie.
That is all we've got time for right now, but our thanks as always to Ben Le Brun at OptionsXpress for his time and comments. For more FX news and updates, do stay tuned to Dukascopy TV. For now though, it's goodbye.